What's up, everybody? I am Jaspreet Singh and welcome to the Minority Mindset and welcome back to our new Monday segment. If I asked you what is the worst investment you can make, what would you say? And when I say worst investment, I mean an actual investment with the purpose of growing your money. So we're not talking about shoes or clothes or cars or saving your money. I'm talking about an actual investment. What is the worst investment you can make? There are a lot of options. I mean, you have the stock market, the real estate market, you have commodities like gold and oil. Out of the investment market or the investment industry, what is the worst investment you can make? So pretty much every investment bank in the world release their own reports as to what's happening in the market. And here I have JP Morgan's Market Insights report, which is titled Guide to the Markets. So I'll come down to page 64 of this market report, and JP Morgan has the 20-year annualized returns by asset class from 1998 until 2017. So let's take a look at this. So here on the left, we have REITs, which are killing it at 9.1% annual returns. So REITs are real estate investment trusts. These are companies that invest in real estate, and you can invest in these companies that invest in real estate through the stock market. And 90% of the money that these companies make, they have to distribute back to shareholders like you through dividends. So you can get that appreciation in the value of the REIT going up, and you can get a lot of dividends as well, and you don't have to do any of the work of owning the real estate. So you have real estate investment trusts, REITs at 9.1%. You have gold at 7.8%, pretty good. The S&P 500, the stock market at 7.2%. This thing called 60-40, which is 60% stock market, 40% bonds at 6.4%. Oil, 40-60, which is the opposite of 60-40, stock market, bonds. You have the EAFE, which is the index that looks at the markets outside of Canada and America. So this EAFE is looking at the indexes in other developed countries outside of America and Canada. Then you have bonds and homes. And after that, at the very bottom of this table, at 2.6% a year average returns, you have the average investor, which is only beating inflation by 0.5%. The average investor is being outperformed by pretty much every major asset class because the average investor clearly is not a good investor. I mean, you could literally just take your money and throw it into any one of these asset classes and you would have gotten a better return than the average investor. So why is that? Well, the reason why the average investor can't even match the market in any of these asset classes is because the average investor is an emotional investor. They invest on emotion rather than financials. And I have a graph here that I really like that shows what I mean. The market starts to soar, and this is when the average investor comes in because they start hearing about the news saying, oh, everything is rising and people are making a killing in the market, you have to buy now. And so people come in and they start buying. And then they hear about their friends making more and more money, so then they buy more, even though they don't necessarily know what's going on. And that's when people realize, oh, this asset, like the stock market, is being overvalued, and so people start to sell. And then people start to get scared and panic, and that's when they start to panic sell, and that makes the market go down even more, so more and more people sell. So people buy at the highest point and they sell at the lowest point because they're investing emotionally. And to really emphasize this point, I found this article from Forbes with the title, Any Monkey Can Beat the Market. And the interesting thing here is this company did a study where they had 100 monkeys take darts and just throw them at stock pages at a newspaper, and then they tracked the stock that these monkeys picked. And over the long run, since 1964, these monkeys, or the average monkey, has outperformed the stock market by around 1.7% a year on average, and none of these monkeys had any sort of financial education before they started investing. The reason they're able to beat the market or even match the market is because they're taking the emotion out of the equation and they're investing for the long term. I mean, the funny thing about this JP Morgan study is that if you just took your money to the bank, you could get a better return than if you tried to invest your money yourself. So I'm not a big fan of CDs. This is a chart on bank rate of historical CD interest rates. A CD is when you go to the bank and you give them your money and it's locked up for a number of months or years and they pay you some interest for having your money. I don't really like CDs because the returns tend to suck. But the really interesting thing here is if you would have just invested your money in a 5-year CD instead of being an average investor, you would have gotten a better return for most of the time. So if we go back to this chart, the average investor got a 2.6% annualized return between 1998 and 2017. Well, if we look at this historical CD rate back in 1998, a 5-year CD was yielding a 5.77% return in 1999, just under a 5% return in 2000, back to 5.5%, and on and on and on. And so you'll see this 5-year CD outperform the average investor every year in 2005, 2006, 2007, 2008, all the way up until 2009. This is where the 5-year CD finally got below 2.6% a year. This is the peak of the market crash when interest rates really started to be cut, so CD rates started to be cut. But between 1998 and 2009, if this average investor just went to the bank and gave the bank their money, they would have gotten a better return than trying to invest their money, because most investors are not investing financially, they're investing emotionally. Now, what does this mean? Am I telling you to go and take all of your money or all of your investment funds and hand it over to a money manager or an investment advisor and let them manage your money for you? No, I'm saying you need to learn how money works. This way you can make smart investments. The average investor is an emotional investor. I want you to be a financial investor. This way you can make smart money decisions for yourself. The simplest thing that you can do is set investment rules for yourself. Like for me, I have 2 investment rules that I follow. First, invest for passive income. And second, never pay full retail price. So the reason I like to invest for passive income is because when I invest my money, I don't like waiting years or decades to see what type of return I get. I like investing my money for cash flow, passive income, which is why I love investing in real estate. And when I invest in the stock market, I look for dividends. So I want that passive income from my investment. And second, never pay full retail price. I always look for deals. So when I invest in real estate, I'm looking for distressed properties, foreclosures, mismanaged properties. I'm looking for places where I can come in and add value. That's why I can buy my investment for a below market price and then add my value to raise the value. But in the meantime, getting passive income along the way. Same concept in the stock market. If I buy stocks, I look for companies that are undervalued. So for me, my rules are I need passive income and I need this below market price. After that, I sit back and I let my investment do its thing. I don't really care what happens to the value of my investment. Like people are always asking, oh, Justpreet, what happens if real estate values go up or down? It really doesn't matter to me if real estate values go down, because I don't buy real estate with the mindset of trying to flip it for 2 or 3 times what I bought it for. If it doubles in value, great. I very rarely sell. My goal is to create passive income. So even if the property value gets cut in half, no big deal, because my goal is to get that passive income and I'm not really worried about the resale price. That's why the first question you have to ask yourself when you invest your money is, what are my investment goals? Is your goal to create passive income? Is it to build this big nest egg so when you reach 65 or 70 years old, you have a lot of money put away? Or is it something else? What are your goals with investing? And this way you can create your investment rules around your goals. It sounds simple, but clearly the average investor is not doing it. Now, if you want to use your money in the smartest way possible, you have to understand what's happening in the finance and business world. And that's why we created the free Minority Mindset newsletter. We take the top finance and business news, we break them down, and then we show you how this news affects your wallet. This way you can make smart money decisions. This newsletter is completely free and you can subscribe to it by clicking the link up here or by clicking the link in the description below. So investors, what are your investment rules? Let me know in the comments below. This way we can all learn from each other. I read every single comment that we get, so I'm interested to see what you say. Let me know in the comments below. Thank you for watching, and as always, keep hustling.